All right, welcome back. This is Goodrich Financial Advisory. Today we're going to talk about should you buy a house. So this is going to be the obligatory maybe. Maybe you should buy a house, maybe you shouldn't buy a house. The environment is crazy. 2021 we saw housing prices explode, and now we're seeing mortgage rates explode. So, should you wait? Should you get in? Is the housing market going to leave you behind? Should you have the FOMO and freak out? Oh my goodness, I'm never going to get in. Well, short answer is you should never make an emotional decision, especially something with an average price of $400,000 and a payback period of 30 years. This is a very important decision. Do not make it lightly. Please do your homework, and some of the homework is what we're going to go over today. So I'm not talking about talking to the experienced investor. I'm not talking to the person who has found their dream home. I'm talking to the person who feels maybe pressured by the real estate agent or their loan underwriter or the broker, whoever, basically providing you some objective information so that you're not, the analogy would be taking advice on how much car you can afford from the car salesman from your local dealership. So, an easy way before we even get started to gut check yourself if you're buying a home for the right reason, or you're selling stock for the right reason, or you're buying stock for the right reason. Assume the market's going to move against you 35% the day after you make your decision. If you're okay with it, then you actually are going to buy a house, your forever home. Everyone's like, just buy your forever home, but then they're not really. In 2 years later, they want to sell it. If you're okay with it moving against you 35% the day after you buy it, then that probably checks the boxes for a forever home. Or if you're trying to sell a house and you're like, oh, the housing market's going to crash, I got to sell everything. Would you be okay if housing went up 35% the day after you sold your house? And so that'll really kind of gut check you to see if you're making this decision with emotion or if you're actually thinking about it. So let's go ahead and get into some numbers. We're going to take a look at Mortgage Daily News, or News Daily, I'm sorry. And so we're going to look at the last 5 years of the 30-year fix. So all the way back, and this one goes to 2019, we're looking at a 429. All the way today, we're looking at a 750. So even up here. So the current 30-year fix is 7.5%. The high was in, I believe, October. Yes, so October 20th, Friday, is 7.97%. We saw a tremendous pullback, and then now we're climbing back up. And what happened right here? Well, actually, we've been having CPI, the measurement of inflation, start pulling up. And so here, everyone thought that we were going to return back to the Federal Reserve's target of 2%. And then we started bouncing around, and now it looks like we're re-accelerating starting in January, coming all the way back up. So this has caused the Fed to guide much lower or higher, I guess, for rate cuts. So most of the rate cutting for this year has actually already been priced out. So let's go back to the 30-year fixed rates, and let's zoom out a little bit. So if we go all the way back to the max distance, all the way back to 71, if you go back to the 80s, this is the gas crisis, the original inflation issue. This is Paul Volcker raising the 30-year fix up to 17% to try and combat inflation. So your standard mortgage rate was 18%, and it has been on a downtrend ever since, all the way until the bottom, we'll call that November of 2020 at 283, and now has been on the upturn since. So what does this mean on a granular today? So you get your 30-year fix at 7.5%, 15 fix at 6.89, so not a tremendous discount for cutting your term period in half. You got your 30-year VA at 6.97, and then you have your 30-year FHA at 6.95. So they're pretty high, they're pretty expensive, over double that from a couple of years ago. So are these rates going to continue to go up? Are they going to put downward pressure on housing prices? Is it going to continue to rise? You can't really predict, because if you would have asked in January, everyone thought that these rates were going to go down, and now they're up. So back to the consumer price index, this is what makes things really hard. This basket and how it's measured changes all the time. The weightings in the basket change all the time. If you're the Fed, you look at core PCE instead of CPI. But anyways, this general trend right here, the last couple of months, is what's changed the market's outlook for the next 12 months, in thinking that the 30-year fixed rate is not going to be coming down anytime soon. So let's look at the yield curve. The Fed has control over the short-term rates, mostly over here, less than 2 years. But at the 2 year, I mean, we're up 80 basis points, so 0.8% from point 0.4 or 4.1 to 4.9. And then if you look all the way to the 30-year, from 3.7 to 4.7, so you're up over 100 basis points, or up over 1 full percent. The 30-year fix is generally based off of the 10-year treasury. And so this number right here is a lot more important for when you're actually looking and trying to guesstimate where 30-year rates are going to go. So let's look at average home prices. This is from the Federal Reserve. If you just type in Fred into Google, it'll pop up fred.stlouisfed.org. You can look all this information up for yourself. So this is from just before the 2008 financial crisis all the way to today. And this is the median home price. So as you can see, housing kind of bottomed in 2012 from the 2009 dip, and everyone thought during this time period that houses was always going to go down and no one ever wanted to buy. Well, as we can see, that was wrong, and it started to climb. And so from 2012 to 2019, everyone thought that housing prices only go up. And so then we had COVID and the collapse, and then housing really accelerated because rates dropped, as we saw on the previous chart. Rates dropped, and now we have the average home price skyrocketing. But now rates are rising, and now we're starting to see a small correction. Are we going to see a 2008 financial crisis? Probably not, at least not in this country. We're not going to talk about China in this video. And their grossly over leveraged, partially bankrupt housing system. But we're just going to talk about the US today. So is this going to go down, or is this going to keep going up? Well, current employment rates, current housing affordability, current payroll states that either rates need to come down or this number is not super sustainable, because the average mortgage rate is way above what it was here, because interest rates are double now. So you have a dramatic increase in housing prices from, we'll call it 384,000 all the way up to, well, at the peak, 552, and a pullback to, what is that, 492. That's still, you added another 130 grand to the price and then doubled the interest rate on that payment. So it's not super sustainable in this current configuration, in the current environment. So let's look at how much more supply is coming on to see if this is going to help. So this is new. If you've noticed in the market that most of the houses being sold are new builds. And the reason this is because it allows home builders to buy down the rate, and so that the home buyers can get something close to 5% instead of having to buy an existing house at 7.5%. But this is broken down by region. So Northeast, Midwest, South, and the West. So obviously most of the volume is happening in the South. And then if we look at unit size, single family, and this is called commercial, anything over 4 units is commercial. So most of the homes being built are single units. Why does this matter for existing home sales? So if we look at the valley in, what is that, January of 2020? Actually, this is May 2020, sorry, May 1st of 2020. 3,910,000 homes. And if we look at now, we had a rebound and a reduction, and now we're at 3,970,000 homes. So we are looking at 60,000 less homes being sold on an annualized basis than the height of the pandemic. And so this is kind of what's locking up home prices and kind of keeping everything in place. And so what's going to happen to the price when this volume starts picking back up, whether it be from unemployment or rates come down or more people moving. So currently the trend now is there's an exodus in high tax states like California, New York, Illinois, Jersey, and an influx into lower tax states, Florida, Texas kind of being the exception. There's no income tax, but the property taxes are kind of steep. And so will that adjust the housing prices in your area and where you're actually trying to buy? And then this right here is kind of the most important chart that I wanted to touch on, that's going to kind of argue against freaking out about renting and trying to get out of that situation and trying to buy a house. So if we look in 2018, we had a rental vacancy rate of 6.6 and a home vacancy rate of 1.5, kind of peaked out at 7, right? And then through the pandemic, like it went all the way down to rental, came all the way down to 5.7, kind of went back up to 6.8, troughed again. And this is when we started seeing a lot of upward pressure in rental prices after the home prices kind of already kind of peaked and started coming back down. But now you're starting to see vacancy rates on rentals climb back up. So this is going to put downward pressure on rentals. That, in combination with the amount of commercial buildings being finished, is going to help keep that kind of under control. So the moral of the story is, do not rush, do not panic. There are many ways around earning money while you're waiting for the market to come to you. It's the same thing in stocks. It's the same thing in crypto. It's the same thing in housing. Housing just moves way slower than everything else. If the rate of change is unsustainable, don't chase the market into it unless you just want the house. So anyways, hope that helped. Hope that made sense. Hope that that allows people to kind of put things into perspective, that there is a lot of risk or downside risk to where the market is right now. That doesn't mean that the housing market is coming down. That just means that, listen, a lot of stuff is up in the air and you need to not be making this decision from emotions. As always, my name is Michael. You're watching Goodrich Financial Advisory, and have a great day.